Welcome back to this lesson. In this lesson, we are going to learn about consolidation. So, what is a consolidation? This is when price moves inside a clear trading range and shows no willingness to move significantly higher or lower. So let us get an illustration before we go into the charts. So the market moves from one price swing to the other, but makes no real movements like expanding. Instead, we get just moving from one price swing or price range from higher, lower, but sideways also. So the market is not making any significant movement higher or lower. So you'll come to find that in this instance, the price is moving just in a range and it's not making any significant movement higher or lower, and it's moving sideways. So what's the importance of learning about consolidations? So in consolidation, this is also a good point for us as a trader to anticipate, because in consolidations we anticipate the skill of knowing that the market is just building orders which will be used by the market makers to run or to create liquidity. So those orders, they are just building up liquidity and building up orders on both sides of the market, and from that we'll expect that the market will move or will expand near term. So essentially what we'll get is when the market consolidates like that, price move from higher, lower. So depending on whether we are buying or selling, if we are in a bullish market, or what the market makers usually do is they first come. Let me draw it again. So what the market makers will do, they'll build up orders, so they won't run any form of liquidity. But if they are planning to buy, the market will come first for these sell stops for the liquidity here, then run higher, run for this, then as they move higher and expand higher. So that's essentially the advantages of a consolidation. So if you see a consolidation, don't see that it is boring, but just have that anticipatory skill in you that this is the building up of orders and the market will come for liquidity on both sides. So if we are also in a bearish market, if this is a bearish market, so the market will create liquidity, pool of liquidity, both sides, then come run the liquidity, then move lower. Yes. So let us see examples in the chart of situations in which the market has consolidated. So we are looking at even the daily chart. In the daily chart, we can see that even here, this is a consolidation. Even here, market is moving sideways. Here, the market is also moving sideways. So you can see that the market is just consolidating. It's not making any significant price move higher or lower until we ran here and then market moved higher. Even at this price range, we can see that the market also I'm drawing using the wrong tool. So we can see that the market consolidated here So market moved sideways, not running any significant liquidity. But we can see that at this point, when we ran this with this liquidity, we ran for the liquidity down, then moved higher significantly. So that's the advantage of consolidation. So when you see a move that has consolidated the next time, just know that for you should be gaining the anticipatory skill that the market will run liquidity on both sides, but there is one particular side in which the market eventually will run higher after running liquidity. So at this so what do we look for in price when the market consolidates? So the impulse swing in price that moves away from the equilibrium, that is found exactly halfway point of the consolidation range. So we know what is our equilibrium. So equilibrium is the midway point of a price move. So what we are interested in is the equilibrium of this particular consolidated move. So let us look at lower time frame, maybe for example 15 minutes. So let us look at an example like here. The market just consolidated, it moved sideways from one point to the other, then eventually ran higher. So this was the market building orders. Then we can see that when we ran this liquidity sell stops, the market immediately moved higher. So that is what we should be learning from consolidations, that when we see a consolidation, we should anticipate that there's a big movement that is about to come. So go into your charts and do more examples and look out for places in which the market consolidated, and then look at afterwards what did the market do, which side of the market did we get a movement away from, and which side of the market did we see a run on liquidity. That's it for this lesson. See you in the next one.